Great. Thanks for having me here. Thanks, Lex and Molly. And thank you, everyone, for joining. As mentioned, I'm Mandy Xu, head of derivatives market intelligence at Cboe Global Markets. We are the oldest and the largest derivatives exchange in the US and the home to SPX and VIX options, as well as many more. And what I wanted to do today is give a very short presentation on themes that we're seeing in the derivatives markets. And then I'll turn it over to Lax and Molly for conversation, for more of a discussion style. But I thought, it's interesting. It'll be interesting to start with some high-level themes and trends that we're seeing at the Cboe, as well as some commonly asked questions that we're getting from investors, both retail as well as institutional. So if we could cue up the slides. Perfect. I know the theme for today is navigating volatile markets. And I think, the first question that people are probably going to ask is, where is the volatility, right? And that's a very fair question. If you look at the VIX index, what has really perplexed a lot of investors, I think, has been the very notable and large decline in volatility that we've seen over the past year, right? So this is just a chart of the VIX index. And so you can see we went from an average of about 26 in 2022 down to 17 last year, and year to date, we're on track of averaging just 14 in terms of level of volatility. For those not familiar, the VIX is a benchmark measure of volatility in the market. It specifically measures how much the S&P 500 index is expected to move in the next 30 days. And what we're seeing in terms of levels of volatility right now, it's near it's one of the lowest, I guess, year-to-date averages that we've seen in recent years. So on the back of that, I think it's surprising to a lot of people given the macro backdrop, right? We still have a lot of uncertainty regarding level of inflation, direction of interest rates, as well as escalating geopolitical tension. So a lot of headlines recently and chatter around kind of why is volatility so low and is it somehow being suppressed? And a lot of the headlines and conversations have focused around this idea of the short volatility trade getting too big and therefore suppressing levels of volatility or levels of the VIX. So let me kind of, back up a little bit and describe what I mean by short volatility, right? So typically people use that term to talk about trades where you take a view on level of volatility, where you make money if volatility declines. So that's what it means to go short volatility. And there are many ways you can do that. Traditionally, you can do it through, VIX options, VIX futures. You could do it with VIX ETPs. Obviously, you can do it through S&P options, typically delta hedged, as well as some, over-the-counter instruments like variance swaps. But lately, a lot of attention has focused around the growth in what, I term what a lot of people call derivative income funds. So these are ETFs and mutual funds that sell options for income, the most popular of which are your cover call overwriting funds. So selling call options on top of stock positions, right? And as you can see in this chart, this is a chart looking at the total assets under management of all the derivative income funds in the Morningstar database, so a pretty comprehensive database. And you'll see in terms of total AUM, that has gone up from about 20 billion in 2019 to now over 130 billion. So a growth of over 6 times in the last couple of years. And why this is coming into the conversation is because these funds, as we mentioned, sell options, right? Typically sell call options for income. So when you sell an option, you are quote unquote selling volatility, you're short volatility. So a lot of people are kind of pointing the finger at these funds and the growth in AUM of these funds as kind of the reason why we're not getting a lot of volatility in the market. I strongly disagree with that. I think that is a misconception of what these funds do. It's a conflation of the term or a misunderstanding of the term short volatility. So kind of let me explain. So why do I not think these funds are part of the reason why volatility is low? Well, first of all, when we typically talk about short volatility trades, right, we're talking about trades that, again, your P&L is directly tied to levels of volatility. These funds, think about a traditional call overwriting strategy or call overwriting fund. Yes, they're selling options, but they're selling options for income. They're not selling options to express a view on volatility, right? And think about a case where, the stock or the broader market sells off, volatility spikes, let's say it even doubles. Well, what happens? Well, you're actually making money in this case on your option position by selling the call, right? You're better off having sold that call versus just holding long stock because now you get to keep the premium. So your P&L is absolutely not tied to the level of volatility. That's number one. Number two, why people look at short volatility trades and are so concerned with the size of the quote unquote short volatility trade is that a lot of times these trades are levered bets on volatility, meaning that if volatility spikes, you will have to cover your trade, you'll be forced to unwind, and that forced unwind can actually exacerbate the volatility move. That's exactly what happened, for example, in February of 2018 during the Volmageddon spike that we saw in the VIX, as well as partly one of the reasons why volatility went to 90, VIX went to 90 in March of 2020. The key thing to keep in mind with these derivative income funds is that they are unlevered, right? They are cash secure, either selling cash secure puts or more commonly covered calls. There's no leverage. Again, market sells off, you're not forced to come up with additional capital as a result of it. So speaking of, okay, so the growth obviously in these strategies, could these strategies, be the reason why volatility is low in the equity market? To me, the most convincing evidence why these are not to blame is the fact that if you look at volatility levels across asset classes, the decline that we have seen is felt or is evident across asset classes, which to me means it must be macro fundamental driven, or to quote James Carville, it's the economy, stupid, right? So the fact that volatility has fallen is not for some nefarious reason or due to growth of any particular strategy. It's really a shift in the macroeconomic outlook that we've gone from everyone fearing a recession, expecting recession, to now firmly on track for a firm landing. We'll see ultimately if we do get that soft landing, but certainly that is the consensus expectation right now. So what this chart shows you, there's a lot of squiggly lines, but essentially it's a cross-asset comparison of volatility across the different asset classes. And we're standardized it by the Z-score. So the way to read this is that each line represents the volatility of a particular asset class compared to its own long-term 10-year history. And the Z-score tells you the current level, how many standard deviations above or below average it's trading. So if it's +2, that means it's rich. It's 2 standard deviations above average. If it's negative, it means it's trading cheap or low. Say it's -1, that's 1 standard deviation below its own long-term average. So what you'll see is, if you look at the start of this chart, which is October of 2022, at that point in time, every single asset class, whether it's rates, whether it's credit, it's commodities, it's FX, every asset class had volatilities trading between 1 to 4 standard deviations above average, right? So that was kind of during the peak, Fed hiking, fear of inflation, fear of hard landing, very elevated volatility across asset classes. Now you fast forward to now, and every asset class, again, with the exception of interest rates, it's trading below average now. And if you look at the red line, which is equity volatility or the VIX, it's firmly kind of middle of the pack, right? It really doesn't stand out as being particularly low or particularly high compared to, say, volatility in the credit market, volatility in the currency markets, or volatility in the commodity market. So to me, again, the fact that it's so broadly felt and seen, experienced across asset classes, to me suggests that the decline volatility is really just a reflection of the improvement in the macroeconomic backdrop. But if we kind of shift back to the idea of kind of short volatility trade and whether or not it's getting too big, one of the things you can look at to really gauge that is the volatility risk premium in the market. So in simplistic terms, what the volatility risk premium measures is the difference between the implied volatility of the market, in this case S&P, versus the realized volatility, how the market actually behaves, right? So this risk premium, this VRP, is historically always positive, typically, right? It's what rewards option sellers. It's, you think about the insurance premium, if you will. If we were to see a lot of sellers in the market, if the market is now being kind of inundated by option sellers, volatility sellers, what we would expect, all else equal, is for the volatility risk premium to shrink, right? For the implied volatility, the difference between implied to realized to be lower than what you typically see. But in fact, what you'll see is over the past year, the volatility risk premium has actually doubled and is actually trading right in line with long-term historical average. So that to me suggests what we're seeing in the market is not a market that is being flooded by volatility sellers or option sellers, because if we were, you would not see this, richening of the volatility risk premium in the market. And then specifically, we focus on the call overwriting trade, which has been, again, in the headlines a lot. A lot of people talk about the growth in cover call writing. What's really interesting, and this is a chart, and I'll explain what this chart shows, is this is a chart of S&P call skew. So it's a little bit maybe esoteric, but what skew typically measures is the difference between, say, the volatility of puts versus calls, right? So skew typically, you can think of it as a sentiment indicator. When skew is high, it typically means there's a lot more demand for puts versus calls, and people are a lot more bearish on the market, a lot more demand for protection. When skew is low, it's the other way around. This chart in particular focuses on the call side. It's looking at call skew, and it does so by looking at the difference of an out-of-the-money call option versus an at-the-money call option. Now, when this line is high, what it means is there's actually a lot of demand for those out-of-the-money call options. That the out-of-the-money call options are actually very expensive relative to the at-the-money. Whereas when this line is low, it means the opposite. It means that there's very little demand for those out-of-the-money call options. People are not very bullish on the market, and call skew is low. So the reason why I think this is relevant is that, again, if you think the dominant kind of theme or flow in the market is call overriders or call sellers, you would expect this line to be very low, for the out-of-the-money call options to be very cheap, as we see a lot more sellers in the market. In fact, what you see is actually the opposite. Call skew is actually at a decade high, meaning that the out-of-the-money call options on the S&P right now is extremely rich relative to the at the money. And it's rich because the dominant force actually in the options market right now, in the S&P at least, it's upside call buyers, people chasing the upside, right? Trying to get that upside exposure through buying of out of the money call options. And we're at levels that's pretty unprecedented, at a 10-year high in the market. So I thought that's interesting. And this demand for upside call option, that's been something that's getting a lot of focus from investors, both institutional as well as retail investors. And a lot of questions I get has been around this idea of, is this kind of complacency in the market, lack of demand that we're seeing for put options, the record high, near record high demand for call options. Are investors too complacent? And one of the things that I always point investors to, you just look at how the S&P is behaving. So forget about what is being priced in the options market. Just look at how the S&P index has been behaving. What's really remarkable is that recently we've seen more volatility on market up days than market down days. So the outsized moves, the big moves, have come on rallies rather than sell-offs. And that's very unusual because typically, as the adage goes, right, the market takes the escalator up and the elevator down, meaning that the down moves are always more violent moves. And that's why typically, puts trade at a very significant premium to calls. But if you look at how it's behaving year to date, we're actually seeing more volatility on up days than down days. And it's been actually the case for now going on almost 2.5 years, right? Ever since 2022, we've seen this inversion in the market in terms of behavior. And if you look at it going back further in time, the last time we've been in a similar environment where the more violent moves have been to the upside, you'd have to go back to the early 2000s, right, on the heels of the tech bubble bursting, to really find a similar dynamic. And I think that's why you're seeing that demand for the upside calls, because people buy options. Part of the reason is at least to manage volatility. And what we're seeing in the market right now is higher volatility on up days. So I think that's really interesting. And certainly, I think it's a reflection or partly driven by positioning, the fact that over, let's say, over the past year, especially if you think about the beginning of last year, consensus investor sentiment was just so bearish. Everyone was underinvested into equities, underallocated to equities. And then obviously on the back of the rally, people having to chase, so using call options to hedge their upside risk rather than downside risk, because that was the risk that they were most vulnerable to. I think that explains why some of the dynamics that we've seen in the options market. Okay, so having said all that, where are we seeing fear in the market, right? We're not really seeing fear in terms of where S&P put options are trading relative to call options. As I mentioned, there's actually been a lot more, the call options are actually really rich right now compared to the put options. Well, one area we are seeing fear in the market, and we talk about navigating volatile markets, where we're seeing record activities, is actually in VIX options. So the first chart on this slide shows you the average daily volume in VIX options, looking at annual averages. And what you'll see is over the past year, we've seen a very significant pickup in VIX option activity. Last year was actually a record year in terms of VIX option volume. And this year to date, at least, we're on track to exceed last year's record. So we're seeing even more options trading this year than we saw in 2017 in the lead up to 2018, the big Volmageddon spike. And if you look at where that volume increase is coming from, it's very much driven by demand for VIX upside calls. So investors buying upside calls in VIX, kind of playing for or hedging against a volatility spike in the market. And it's really notable, and especially because we're not really seeing an equivalent explosion in VIX options. So I would say the difference between hedging with VIX options versus, say, S&P put options is that VIX options I think of as more of a tail hedge, right? It really pays out when we get that big black swan event that causes volatility to really double or triple. So people buy VIX upside call options for that convexity, right? That explosive move in the VIX when we get that big tail event that hit the market. Think, March 2020, for example, when VIX went to 90, or Volmageddon, again, when VIX spiked very quickly over the course of a day or two. And it's easier, obviously, to get that big move in the VIX when it starts out at a low base, right? So when VIX was trading in the mid-20s, as it was in 2022, it would take a big catalyst for it to double or triple. Whereas now VIX at 12, it doesn't take a lot for VIX to go from 12 to 24 or from 12 to 36. So part of it, I would say, is a function of just lower levels of volatility to begin with, right? You can, more easily see a jump in volatility, hence the increase in interest. And again, it's not surprising that the previous record that we saw in VIX options was in 2017, which was a record low year in terms of volatility for the broader equity market. But I would say that's, one factor. Certainly is not the only factor, because you've seen years in the past, for example, 2019, which was also a low volatility year, where there was positioning. And this is particularly for institutional investors, as they get more and more levered, or as they increase allocation into equities, that demand for hedging naturally increases. And right now, in terms of what people preferring, they prefer VIX options because of the fact that it kind of holds with VIX at, when you buy an S&P put option, the market continually kind of goes up, your put option becomes worthless much quicker than, say, a VIX option. But I do want to just flag the kind of the record activity that we in VIX options. This flag last month, April 12th, if you recall, that was the day when Israel had that that potential escalation that people were really worried about. We had 2.6 million contract VIX options on that single day, higher than any point. If we flip to the next slide, in terms of catalysts that people are focused focusing on, one of the things I think is worth highlighting is just what is being priced. Action might be having a problem. Hold on one second. So I do want to highlight kind of what is currently being priced into the volatility markets for the US election. And already we're seeing a pretty healthy risk premium being embedded in the VIX futures curve. So VIX futures curve, what I'm referring to is, VIX futures. So, out of different tenors. So you'll see in the first chart, you'll see where the spot, which is where VIX index currently is trading. And then you'll see the price of the various different tenored futures, right? The May future, June future, July, et cetera, going forward. And what you'll notice is a very big bump for the October future relative to the September future. So right now it's about a 2.5-point premium that is being embedded into the October future versus the September. So really reflecting the expectation that volatility is going to be about 2.5 points compared to September. Now, what's really interesting about this election risk premium that we're seeing in the VIX future curve, first is that a lot earlier than in previous election cycles. For example, in 2020, at this point in the interest curve, now it's 2.5, right? So it's a lot bigger. And secondly, given all the headlines and potential talk about contested election, what is also notable is that that's not what is currently being priced into the market. If you look at the November future, it's actually showing lower levels of volatility compared to October. So expectation that volatility will normalize, will subside post the election. Now, one of the reasons I think that we are getting this kind of meaningful election risk premium being priced into the market this early on is the fact that the last two elections have produced pretty notable increases in volatility, right? So the second chart kind of shows you the increase in the VIX index in the month leading up to the election for the last 30 years. And you'll see is that outside of 2008, which if you recall, that was the global financial crisis, right? So I would say that's a very unique case. So if we exclude 2008, the last two elections, any other election cycle in the last 30 years. So I think due to this recency bias and the fact that we have similar slate of candidates running this time around, I think the market's getting ready for that volatility pickup, a lot sooner than typical. So with that, I'm going to pause here. I do want to, flag that we are publishing both a weekly note as well as periodic notes around themes and flows that we're seeing in the derivatives market. So if you are interested and you want to subscribe, screen a QR code where that will take you to the webpage, as well as a periodic note around notable themes and flows that we are seeing in the derivatives market. In addition, I'm also running a monthly webinar, usually with guest speakers from around the industry, around relevant topics as well as new products that the Cboe is introducing. So